Alrighty, are we live? Okay. Well, good morning, ladies and gentlemen. Welcome to another Self-Directed Saturdays. My name is Freeman White. I'm an IRA specialist with Quest Trust Company. We've got an exciting day for you today. Just to dive right into it and not hold back. Remember the position Quest Trust Company is in. I'd like for you to know that we do not offer tax, legal, or investment advice. Everything you hear today is strictly for educational purposes. And so just keep that in mind when we're considering the content for further details and confirmation. You may want to speak to your tax professional, your lawyer, or your CPA. Okay. Just to outline events for today, we've got a number of things lined up in upcoming months. Of course, you're here on Self-Directed Saturdays today, but we do have our IRA quarterly events. We actually just had one this last week where we, provided kind of like a Valentine's Day duo for couples that invest together. We also have coming up our National Networking Happy Hour that occurs every fourth Wednesday at 6:30 p.m. We have our Power Play Tuesdays for those of you looking to hear about what's going on in the investment world and kind of introduce your current offerings and just kind of meet with like-minded people. And then last but not least, we do have our YouTube channel where we put out most of our educational content. I'll throw those feeds or those slides in the chat just in case you kind of want to reference those below. But let's go on and dive into our further events. We've got a couple things coming up. Saturday, March 23rd, the Path to Wealth for the Next Generation. We're going to be speaking with some millennial investors and just kind of see how they're switching up things from the old traditional conservative kind of ways. Okay. We've also got financial freedom strategies from veterans turn investors. This is our military appreciation educational sessions. They occur on May 2nd, May 7th, and May 14th. And last but not least, we've got our Big Quest Expo coming up. It's everything self-directed. If you're looking to meet with individuals, learn more about opportunities available to you and everything self-directed from specialists, IRA, senior IRA specialists, as well as industry professionals. This event's going to be going on towards the end of June in the Dallas, Irving areas. So stay tuned. And last but not least, again, we've got, if you're looking to hear more about self-directed IRAs, you can speak with an IRA specialist by scanning this QR code. We're happy to get you situated with Quest, get your account open. And if you have any questions or concerns, we can point you in the right avenue. Okay. But now on to our presenter. Guys, you guys are in for a treat today. We've got Nima Farzaneh in today. He's going to speak with you, and I don't want to hold him back any further. So, Nima, you there with me today?
I am here. It's a pleasure to be here this fine Saturday afternoon. And been on here before, so I'm glad to be back. And thank you.
Yeah, glad to have you here today. I hear today you're going to talk with about the new Corporate Transparency Act and to individuals and kind of go over what that means. This may be new to some of you guys, but definitely something to kind of keep in mind. I'm really excited to have you here again, Nima. I'm just going to let you go ahead and dive right into it. So without further ado, guys, here's Nima Farzaneh. Take it away.
Thank you so much. So my name's Nima Farzaneh. I'm a partner with Platt Richmond PLC, and we're a business law firm in Dallas and Houston, Texas. I am a partner that focuses primarily in tax planning, but I also handle corporate and M&A transactions. And today we're going to be talking about the much anticipated Corporate Transparency Act and beneficial ownership, and really what you need to know as an individual investor and business owner. There's been a lot of talk about the CTA both in the accountancy field as well as the legal field. And if you've talked to your CPA about beneficial ownership, you may be surprised to learn that most CPAs will not file that form for you. That is a change, but they're, you know, the national accountancy group that, you know, like the American Bar Association, but for accountants, has looked at the issue, and they think that preparing those forms may be the practice of law. So a lot of CPAs are now kind of referring you to lawyers and other kind of service providers. So there, because of that, there's going to be a lot more burden on individuals to do accurate reporting. And so hopefully this will help you in your quest to be compliant with this law. As a bit of a little disclaimer up front, this presentation is based on available information that's out there currently and current guidance. So this is not like new legislation, but it's newly in effect. And so, you know, we anticipate that the Treasury Department and Congress potentially could, you know, amend the legislation or issue additional guidance to help people comply with this law. And so this is, again, based on what's currently out there. And so it could change if additional information comes out. This is not intended to be legal advice or tax advice. This is purely for educational purposes only. And so if you have a particular question, we'll have some time at the end of the presentation for Q&A, but if you have a particular question about your particular circumstance, I do strongly advise that you speak to your own attorney or a tax advisor about it, or your other professional advisors, because they'll have more information about your specific situation. So what's on the agenda today? So we're going to talk a little bit about what the CTA is. We're going to talk about who needs to file a beneficial ownership report, what that is, who are beneficial owners, who are company applicants, and we'll talk about what these mean. And we'll go through how you file one. And if you'll be surprised that it's not as hard as you think. Most of the work here is going to be on determining who beneficial owners are, who the company applicants are, and whether a beneficial ownership report even needs to be filed. There are a lot of exemptions or exceptions to that rule. But actually filing the report is fairly straightforward once you have all the information. And we'll kind of walk through that. I have some screenshots of the actual website where you would go to file the report. So what is the CTA? So the CTA, or Corporate Transparency Act, was enacted in 2021 in an effort to combat illicit activity, including tax fraud, money laundering, and financing for terrorism, by capturing more information regarding specific U.S. businesses operating in or accessing the country's market. So many of you may be familiar with Delaware. Delaware is a prime example of why Congress felt that this law was needed. If you go onto the Delaware Secretary of State website and you try to search for an LLC name or a corporation name, the only thing you're going to find is the name of the entity and the registered agent. You will have no access to any of the information regarding who owns that entity, who formed it, things like that. Even if you were to be able to request the filing that was filed, Delaware doesn't require you to list the names or of the governing persons or owners in their LLC formation. Some states do, but Delaware is one of those that doesn't. And a lot of people like Delaware because they don't want their information public. The problem is that, you know, for personal privacy reasons, you know, most of us aren't criminals, and we're not, you know, looking to evade the law or shield from the government what we own. But a lot of criminals are, and so they leverage these states that don't require this public information reporting, and they use these as shields. And so what the Treasury Department and Congress have want is better information about these entities, so that they can track down these networks that are funding terrorism and that sort of thing. Now, you may be asking, well, I file a tax return, and a lot of you may file a partnership tax return or an S Corp tax return or a C Corp tax return. And all of those returns usually have information about significant owners of those entities. And you may be wondering, well, why do I need to report this? Well, there are a lot of strategies that can be enacted to kind of shield the ownership. by using offshore entities, by using trusts and other things. So the actual owner or nominees even, so the actual beneficial owner of those interests, and I use that term purposefully, could be shielded here. And so Congress and the government really felt that it was necessary to start actually requiring people to, to report to them in a confidential manner who owns these entities. And so really the target of this law is folks with criminal intent or malicious intent and money laundering and things like that. And if you've heard of the Panama Papers, that's a prime example of why something like this is needed, is to really better, at least in the things that the US government can control, to better have access to information. So who needs to file an ownership report? And by who, I mean what companies, what business entities need to file a report? Those in the act, and then if you go to the FinCEN website, you'll see that they're referred to as reporting companies, and there are two types: domestic and foreign. Okay, so even foreign entities. So if you have an investor in a business that you run or a fund that you run that is a foreign entity, and that foreign entity is registered to do business in the U.S., that foreign entity would need to be needed to be a reporting company. Similarly, you may need to report beneficial ownership of foreign entities. So keep in mind, just because that entity is not formed in the U.S. does not mean it may not be subject to reporting liability here. But primarily, we'll talk mostly about domestic reporting companies, which are corporations, LLCs, could be limited partnerships, limited liability partnerships, series LLCs, series limited partnerships, basically any entity that would be created by filing a document with the Secretary of State of a state or a similar office. Not every state has a Secretary of State that's in charge of business filings. Texas has a Secretary of State, and that's the governmental entity that handles corporate or business formations. Another thing to keep in mind: statutory trusts, business trusts, or foundations may be reporting companies if that trust or foundation is created by filing a document with the Secretary of State. So again, the primary consideration here is the filing of a certificate or something with the state to create the entity. Okay. Now there's an exception to that, and it's the sole proprietorship. So if Nima Farzaneh, doing business as tax law guru, right? If I file a DBA with my county, which is what you would do here in the state of Texas, to have a fictitious name and operate as a sole proprietorship, that does not create, and the Treasury Department has said that does not create the obligation to file a BOR for that business. Okay, so similarly, filing, if I went to go if I filed a DBA, again, Nima Farzaneh individually as a sole proprietor doing business as tax law guru goes and requests an EIN number with the IRS, so because I'm going to hire employees under my sole proprietorship. Again, not recommending you do this, but using it as an example. That filing of the EIN does not create the obligation, nor does my having a law license like I do in the state of Texas create that obligation. It really is, if I were to go online, fill out a form to create a limited liability company or a professional limited liability company called Tax Law Guru LLC, and I filed that does create the obligation. Okay, so I want to keep that in mind, because there may be some folks out there that have a kind of side business in their personal name, and they have filed a DBA form with their county or local registrar to be able to do business under a fictitious name, and they may even have an EIN and a business bank account, but that in and of itself does not. One other quirk to think about is in the state of Texas, and I talk about this because I'm a Texas lawyer, but in the state of Texas, to create a general partnership, and if you listen to my presentation last year on entity types, you'll know what a general partnership is. But a general partnership can be created by agreement in the state of Texas. There is no filing to create a general partnership. That general partnership, you would sign a partnership agreement and you would file a DBA with your local county in the state of Texas to create a fictitious name. That does not create the partnership. That just gives the partnership a fictitious name to operate under. a business name to operate under. But the actual creation is done by that agreement, that partnership agreement that's signed. And that quirk means that that general partnership may not be a domestic reporting company. But if that general partnership was to then go and say, well, we want to be a general partnership, but be a limited liability partnership, and we file something with the Secretary of State of the state of Texas to make us go from a general partnership to a limited liability partnership, that does create a BOR filing obligation for that entity. So so that's something to keep in mind, is that in some states, some business entities can be created by agreement and there's not a specific filing that you have to make with the Secretary of State. And in that instance, based on the guidance currently, that entity, that general partnership, does not need to file. So that's something to keep in mind. With respect to foreign reporting companies, really the key is that foreign entity have to file something with the Secretary of State to register to do business in that state. If you're familiar with multiple state business entities, some entities that are formed in one state will, if they have sufficient activity in another state, are required to register to do business as a foreign entity in that state. So if a foreign corporation, let's say a UK private limited company, wants to do business in the US, they may register in Texas or New York to do business in that state as a foreign business. And that registration would obligate them to file a BOR report. So now there are a lot of exceptions. I say a couple of exceptions here to the reporting requirements. So the first step is, are you a domestic or foreign reporting company? In other words, were you an actual company that was formed or formed by filing something with the Secretary of State? And if you are, then you have to look and see if there's an exception. A lot of these exceptions you see on this, like securities reporting issuer, is basically a publicly traded company. So IBM doesn't need to file this, right? Or Dell, because or I guess Dell may need to file it, but Tesla does not need to file because they are a publicly traded company. They issue securities under a registered securities under the SEC. Governmental authorities do not need to file. Banks, credit unions, these are all governed by other kind of registration requirements, both state and federal. Money services businesses, broker dealers have to register under the Securities Exchange. There's certain Securities Act. Investment companies or investment company advisors, venture capital fund advisors, insurance companies, state license. Again, all these licenses and registrations require ownership reporting, and there's a lot of built-in ownership reporting information sharing, and that's why they're not required. Oddly enough, accounting firms are included on this list, but law firms are not. So my law firm will have to file by the end of the year a beneficial ownership report. Public utilities, financial market utilities, and pooled investment vehicles. I'm going to talk a little bit about some of these other exceptions down here, but one of them is a tax-exempt entity. This is an entity that's exempt under 501c. So if you're part of a charity, a 501c3 charity or 501c6 non-business nonprofit or chamber of commerce that's on tax exempt under 501c or 527 of the code, then you're not required to file a BOR report. This entity assisting tax exempt entity is really kind of like, it's a special case scenario. So I would suggest if you think you fall under that exception, to speak with your lawyer about it. The three I really want to talk about are inactive entities, subsidiary of certain exempt entities, and large operating companies. So this is probably the most common exception that a average business owner may fall under, and it's called the large operating company exception. And basically there's several requirements. The first one is that you have to employ 20 full-time employees, and these are not 20 quote unquote employees that are really independent contractors or 1099. These are actual W-2 employees that you withhold, that you pay withholding taxes and employment taxes on, that you're issuing W-2s to. And they all have at least more than 20 full-time employees have to be employed in the US. So it's not just 20, so 21 or more, think about it that way. And they all have to be in the US. So in a state in the US, And then you have to have a physical office in the US. You can't have a mailbox. You actually have to have an office with, you know, potentially at least 1 or 2 people working there. It's got a physical address, you know, that sort of thing. And then your federal income tax return has to show at least more than $5 million in gross receipts or sales. So you have to have substantial operations. So if you have you may have an LLC with 20 employees in a storefront, but if your business only, you know, grosses $500,000, and you don't qualify for this exception. Now, if this $5 million in gross receipts and sales applies on a consolidated basis, and that consolidation really requires a consolidated return. So if you have several corporations that are all commonly owned and they all file one Form 1120, that's a consolidated return form, you can accumulate or aggregate all of their gross revenues because that happens on that return. And so if that one return is more than $5 million, then that is permitted. Then all those entities are considered accepted. And then if you have gross receipts or sales from the outside the U.S., those have to be excluded from the 5 million. So you're looking at U.S. source gross receipts or revenue of over 5 million. Now, the second exception is subsidiaries. So if there are if you have an entity that's a subsidiary of certain entities that are themselves accepted, right? And it's not every single exception, but it's these specific ones. The first one being large operating companies. So if you have a large operating company and you have like 20 subsidiaries underneath it, let's say you operate in 20 states, and each state you formed an LLC to operate in that state for liability protection. You have a holding company on top of that, and that holding company, everything aggregated together, does more than 5 million and has more than 20 employees in the US. Then all those subsidiaries qualify under the subsidiary election, so you don't have to file. So that's nice. If you have a parent subsidiary structure and you meet that large operating company exception at the parent level, then all those entities are accepted. The rest of these are, again, some exceptions from that laundry list, securities reporting. So again, publicly traded companies, governmental authorities, securities exchange or clearing agency, that sort of thing. The last one is inactive entity. And so an inactive entity is exempt if the entity in existence on or before January 1, 2020. So it needed to be created in 2019 or earlier. It's not currently engaged in active business, and it's not owned by a foreign person, whether directly or indirectly, wholly or partially. So a foreign person means a person who is not a United States person. That's usually a citizen or permanent resident, or a foreign person that has certain visa status that resides in the U.S. for a certain period of time, a domestic partnership or corporation, or certain estates and trusts. That entity has not experienced any change in ownership in the preceding 12-month period. The entity has not sent or received any funds in an amount greater than $1,000, either directly or through any financial account in which the entity or any affiliate of the entity has any interest in the last 12 months. And it doesn't own any other type of assets, whether in the United States or abroad, or including any ownerships and interest in any corporation, LLC, or other similar entities. So basically, think of it as you filed to create back in 2019. You went online and you went to the Delaware Secretary of State website and you filed to create, Joe Smith LLC, and you didn't do anything with it. You just let it sit there. Every year, the Delaware Secretary of State sends you a bill for $400 and you pay it. You're thinking that one day you're going to need to use that LLC, but you haven't done anything with it. Well, that entity could qualify for this inactive entity, assuming you really haven't done anything with it. Now, once you start putting assets in it, or you start changing the ownership or start doing business with it, you have to report, right? And if you go on to and we're not going to cover this in this presentation, but if you go on to the FinCEN website and you actually start the process to file the report, there is an option to say that this is a new report from a previously inactive entity. And so you can, there's a thing that you can select, so that way you don't get pinged with a penalty. And we'll talk about what those penalties are. Okay, so those are the exceptions. So let's just say, you do not your company, your LLC does not fall within those exceptions because you don't have more than 20 employees, or more than 5 million in gross receipts, and you don't fall within any of those other registration requirements or registered kind of company exclusions. So now you need to figure out who your beneficial owners are. And a reporting entity is required. The primary reason for filing this report is to report all its beneficial owners. Now, a beneficial owner is an individual who either directly or indirectly exercises substantial control over the reporting company, or owns or controls at least 25% of the reporting company's ownership interest. Notice how I said individual. You won't report on the beneficial ownership. You won't report other entities. You have to look through, and we'll have an example of how you do that. You have to look through to the individual owners, estates, or trusts, and actually through those trusts, the individuals that are owners, either trustees or beneficiaries of those trusts or estates, to find out who those beneficial owners are. So this is individuals only, okay, that either exercise substantial control over the reporting company, or own or control at least 25% of the reporting company's ownership interest. So let's talk about substantial control. What is substantial control? So an individual can exercise substantial control over a reporting company in 4 different ways. And if they fall into any of these categories, the individual's exercising substantial control. The first is if they're a senior officer. Think president, chief financial officer, general counsel, chief executive officer, chief operating officer, secretary, treasurer, or anybody that's, think C-suite, right? That has that is considered a senior officer. An individual that has the authority to appoint or remove certain officers or a majority of the directors of the reporting company. Now, usually in a corporation, this is left to the shareholders, but in some or an LLC, the LLC agreement will provide. Now, for some of you on this webcast that may have raised funds from investors, or from investors who have invested in companies, sometimes you work out special deals with your with the company you're investing in, or with your investors, where they get to appoint managers, directors, officers. They get to pick their own, right? And so if you have that right, or your entity has that right, then you may be a beneficial owner, or that person who has that right ultimately will be a beneficial owner. And then the last is an important decision maker of the company. Basically, this is a person that has any other form of substantial control over the company. And so, and we'll go through what these are specifically, but those are the 4. And the last part, any other form of substantial control, is really a catch-all. And this is straight out of the Department of Treasury's guide. And so this really kind of walks through some of these. Again, really important decision makers, nature, scope of attributes of the business, finances, if any sort of like entering into loans and things like that, if they have the ability to make decisions about reorganizations, mergers, amending governance documents. And then the catch-all really is that any of these kind of new ways to create decision-making control. So like in the context of an LLC, sometimes we will, as lawyers, draft for certain owners, certain members will have certain decision-making authority or voting authority. And that may, even though it's not, make them an important decision maker, that could put them in this catch-all category. Again, you have to really look at that substantial control, these factors, and the thing to keep in mind with respect to trusts, right? And a lot of you folks may have a SDIRA or solo 401k, and you may be the trustee of that trust. Rob's plan is a great example of one, where the individual beneficiary may also be the trustee and owns your SDIRA LLC. Well, the trustee of that trust may have you being the trustee of your SDIRA may be a beneficial owner exercising because of substantial control. So you have to really look at these factors to really determine that. So again, let's walk through these real quick. So important decision maker is selecting, terminating business lines, major decisions, right? And this could be direct board members of the board of directors, right? Introducing or termination of significant contracts. Again, veto power. So those are things to keep in mind. The next is ownership interest. So we talked about substantial control, right? Next is ownership interest. So we have this 25% ownership interest. And there are a number of different ways that you can look at this. The first one is pretty straightforward: equity or stock, right? So membership interest, membership units, partnership interest, partnership units in LLC, or state law partnerships that are classified as S or C corporations. So stock can mean membership interest in an LLC that's taxed as an S corp or a C corp, or if you grant specific voting rights to somebody, right? A capital profits interest in a partnership or LLC that's classified as a partnership. So if you're a promoter of a real estate joint venture and you're not individually a member or manager, maybe you just help put the deal together, but you got a profits interest, right? And that profits interest could make you a beneficial owner depending on what that profits interest entitles you. A membership interest in a LLC that is disregarded. Again, a disregarded entity, again, tax classification does not matter for this reporting. It really, you look at the state law ownership. And if it's an LLC that's disregarded because it's a single member, that ownership still counts. And we have an example of what that looked like. Convertible instruments. So if you've raised capital through convertible debt or safes or warrants, those receipt holders may be considered beneficial owners of your company because they have this right to convert their debt or safe into equity. Options, options and non-binding privileges to buy and sell options or stock could be considered as beneficial ownership. The exception there is if the option or privilege is created or held by others without the company knowing. So like if somebody created an option or to buy their shares in your ownership, let's say you've got a business partner that you own an LLC 50-50 with. That business partner then needed to borrow money. And so they went and sold an option to buy their 50% ownership in this LLC and didn't tell anybody, right? Now, most LLC agreements will have restrictions on that, but let's just say, for example, they didn't do that. That option does not, even though technically would make that option holder a beneficial owner, because the LLC and the other partner really didn't know, it potentially could be excluded, right? And again, in that instance, you probably should talk to a lawyer about that. Likely, we would recommend reporting it anyways. And then the last is a catch-all: any other instrument, contract, arrangement, understanding, relationship, or mechanism used to establish ownership. So individuals, we're going to continue on ownership interests. So individuals can directly or indirectly own or control ownership interests. They can control ownerships through contracts, arrangements, understanding, relationships, or otherwise. So joint ownership with one or more persons of an undivided interest in an ownership interest. So a lot of times, husbands and wives will own a limited partnership interest in an investment together jointly named. Therefore, they may both be considered beneficial owners. If you put a ownership entity in between, that can create that. An individual acting as a nominee, intermediary, or custodian or agent. So again, a nominee arrangement does not obviate this. Similarly with trusts. So a trustee or other individual with authority to dispose of trust assets could be a beneficial owner. A beneficiary who's the sole permissible recipient of trust income or principal who has the right to demand a distribution or withdraw substantially all the trust assets may be a beneficial owner. A grantor or settler who has the right to revoke, otherwise withdraw trust assets. is maybe considered a beneficial owner. In the context of an SDRA or solo 401k, the good news is the plan or account itself is not a reporting entity. Like a trust itself is not a reporting entity. It's not a business entity. It wasn't created by filing a Secretary of State filing. So the plan itself, just because you have an SDRA account and you're investing with it, does not create the obligation for you to file a beneficial ownership report for your SDRA, right? And if that SDRA is invested in publicly traded stocks, then it does not, then there is really no BOR reporting obligation with respect to those investments either. However, if that SDRA, which is very common, owns an LLC through which that investing is occurring, that LLC or other business entity will likely have a BOR reporting requirement. Similarly, a ROBS plan. If you have a ROBS plan that owns stock in your business, that ROBS plan and the beneficiaries of that ROBS plan may be beneficial owners. So you may need to look at your ownership structure to see if you have any beneficial owners that are ROBS plans and other types of beneficial benefit plans. So that's something unique. There are exceptions to individual beneficial owners. So minor children. Minor children under the laws of the state in which the domestic reporting, it's not where they reside, it's where the entity was created or registered. So if you registered in Delaware, you have to look to see what Delaware uses as a minor. Nominee, intermediary, custodian, or agent, if they merely act on behalf of the actual beneficial owner as a beneficial owner's nominee, intermediary, custodian, or agent. So if I have a nominee, let's say I own a LLC interest in a business entity, and I have a nominee arrangement where somebody else is my nominee. They're the record owner, but I actually have the beneficial ownership of that entity, of that interest. That nominee is not required to be reported as a beneficial owner. I am. So the actual beneficiary is required to be reported. So if you serve as a nominee or custodian or agent on behalf of somebody who actually has beneficial ownership of the security or ownership interest in a company that is a reporting company, you may need to advise that beneficiary that likely they're going to need to provide information with respect to that ownership. An employee. So the thing to keep in mind with an employee is this is relating to just general employees. This is not employees that are senior officers or exercise substantial control, right? So if I'm just like a sales manager and I have stock in a small business that doesn't meet the $5 million requirement, or I have some options, right? But I'm just an employee, and those options maybe 25% of the company, I'm not required to be considered an employee because that's I'm excluded from that. An inheritor. So if the individual's only interest in the reporting company is a future interest in the company, the right of inheritance. So if you have a LLC that you own and your will says your children are to inherit that LLC, your children are not beneficial owners. You are, but your children don't have to be reported. Similarly, a creditor who has a debt or loan covenant. Basically, a lot of times if you pledge securities as collateral, they'll want a security interest in the dividends and other things. That may create an exclusion if you're a creditor in that instance. So let's talk about some examples. So in this first example, we have a reporting company that's a limited liability company. Individual A is the sole owner and president of the company and makes important decisions for the company. Nobody else owns or controls the ownership interest in the company or exercises substantial control over the company. If you guess that individual A is a beneficial owner, you're absolutely correct. Not only are they a beneficial owner because they are the sole owner of the LLC, but they're a beneficial owner because they are the president. So they're a senior officer, and they have the capacity to make important decisions on behalf of the LLC. So the next example, we're going to complicate it a little bit. So this is a corporation. The company's total outstanding ownership of interests are shares of stock. 3 people, A, B, and C, you'll see down there below, own 50%, 40%, and 10% of the stock respectively. And one other person, individual D, acts as president for the company, but doesn't own any other stock. So the question is, who are the beneficial owners? Well, the first beneficial owner is really easy, individual A and individual B, because they both own 25% or more of the stock. So they would be beneficial owners. Individual C is not a beneficial owner because individual C only owns 10% of the stock, but does not have any other substantial control over the company. And so therefore, individual C is not a beneficial owner. Individual D is a beneficial owner because individual D is the president of the company and therefore has substantial control over the company. So this reporting company's BOR report will show individual A, individual B, and individual D as beneficial owners. This is the next example. We're going to complicate it a little bit more. The reporting company is an LLC with two managers, individuals A and C. Individual A also owns 50% of the membership units in the LLC, while individual C does not. Individual B owns 50%, the remaining 50% of the membership units in the LLC, but is not a manager. Who are the beneficial owners? The answer here is all three. Individual C, because they are manager, and managers typically are considered in the LLC world senior officers. They have substantial control, or they may be considered directors depending on how the LLC agreement is structured. So managers in the context of an LLC are similar to directors, and they typically under state law have the members are delegating the control over the LLC to their managers. That's what pretty much every state law out there says, including Delaware. If managers are elected, it's a manager-managed LLC, your managers are beneficial owners because they exercise substantial control. Individual A is a beneficial owner because individual A exercises substantial control as not only a manager, but also a 50% owner. Again, more than 25% ownership. And then individual B, they may not be a manager and they may not have any other substantial control, but they own 50% of the ownership. And therefore, they are beneficial owners. Okay, this last one is probably the most complex here, but it really does give you a good example of the look through that you have to go through here. And so let's look through this. So A is a reporting company, or a reporting company here is a corporation with multiple direct owners through company Y and company Z. Okay, so you have company Y owns 50% and company Z owns 50%. Of company Y, we have individual A that owns 30% of the stock of company Y and is a CFO. Individual B owns 70% of the stock Y. Of company Y. Individual A owns 25% of company Z stock and is a CFO. And individual C is CEO and president and owns 25%. Individual D is a 25% passive shareholder of company Z. And individual E is also a 25% passive investor in company Z. Individual F directs important decisions through board representation. Okay. So in this example, A, B, C, and F are beneficial owners. Individual A is the reporting company's CFO, and therefore is a senior officer. So individual A exercises substantial control. Individual A also indirectly owns 27.5% of the company's stock through his 30% ownership in company Y. And in company C, company Z. Company B owns, individual B, even though they're not an officer, owns 70% of company Y stock, and therefore indirectly owns more than 25% of the reporting company's stock. And so therefore he owns more than the 25% indirectly. And then individual A is CFO of both and owns company Y and Z. And then individual C is CEO and president of the reporting company, even though individual C does not own more than 25% because he only owns 12.5% indirectly of the company, of the reporting company stock. He is CEO and president and therefore has substantial control over the reporting company. Individual D and E do not own more than 25% and they're not they're not officers or exercise substantial control, and therefore they are not beneficial owners. Individual F, because individual F directs important decisions through the board, individual F has substantial control over the reporting company and therefore is a beneficial owner. So as you can see, you have to start looking through ownership to the actual individual owners, and then you have to apportion stock. So it's a little bit of math here in this example, but this is a great example of how you would have, what you would have to do as a person handling the reporting for this reporting company, this example, to really work through your ownership tree to figure out who the actual individual owners are. And all these examples, and in fact, all the information I'm kind of going over here is actually freely available. These examples are directly from there's a small business guide, and I have a link to it at the end of this presentation, which you can download off FinCEN's website, which will kind of have all this information there in a little bit more detail. And there are FAQs as well on their website that you can kind of click through, and it may answer your questions. So the next question, so now we know who our beneficial owners are, what beneficial owners are. The next question is, who is a company applicant? And a company applicant really only applies to newly created companies. So companies that are formed on or after January 1, 2024. So if you have a company or an LLC that was formed prior to January 1, 2024, so in 2023 or earlier, you don't have to report this. And there is a box you would check when you file your initial report to say, I'm a company, an existing company, I don't need to make this report. But if you formed a brand new entity on Jan 1 or yesterday or 2 weeks ago, you're going to have to report your company applicants. Now, company applicants are really the persons that actually form the entity. They actually file the entity. So the best example is, let's say you hired your lawyer to form your company, and let's say you hired me, and I went online to the Texas Secretary of State website, and I filled out the certificate of formation for your LLC, and I hit submit. I would be the direct filer, and as your attorney, I would provide you my FinCEN number, reporting number, so that you could include it as me as a company applicant. Okay, if you went online to the Texas Secretary of State website and created a Texas LLC yourself, you filled out all the information, you submitted the form, you paid the filing fee yourself, nobody else did it for you, you would be a company applicant. You would be a direct filer, and I would be a direct filer in that instance, right? Now, let's say you hired me to form your LLC, and I went to my paralegal, who's a lovely lady, and I said, paralegal, this is the information. Can you form this LLC for my client? My paralegal is the direct filer because she went online and she formed the entity by filling out the information and filing the certificate. Okay. Now I become what's called a person who directs or controls the filing action because I oversaw her filing. I reviewed the filing document. I did all of that. So you wouldn't be, because you're the client. Myself and my paralegal would now have to provide you with our filing number. If you go to LegalZoom and you pay LegalZoom to form your LLC, LegalZoom and whoever at LegalZoom is handling the filing would have to provide you not only the direct filer's information, but the person who's their manager may have to file that information. So company applicants are individuals. Companies or legal entities cannot be company applicants. How do you file the report? So the first step is to gather information. So you're going to need to determine who your company applicants are and who your beneficial owners are. Right, so you're going to go gather that information. And so from each beneficial owner or company applicant, you're going to need their name, date of birth, residential address. If that person's only a company applicant, that company applicant, they can provide a business address. But a beneficial owner has to provide a residential address, a physical address. PO boxes don't work. Okay. A copy of a passport or driver's license, and you have to provide the number and state of issuance, and they will actually have to provide a copy of that deal. Now, you can go online if you're going to be a beneficial owner, you can actually go onto a FinCEN website and create your own ID number. And I recommend, if you are going to have a filing obligation, because you own interest in a reporting company, that you do that. Why? Because if you don't do that, you have to provide copies of your passport and all this information to the reporting company. And you may not know what their security, information security is. You're going to have to email all this. You have to provide copies of your driver's license and stuff like that. And a lot of people don't. They want to keep that information private. So what you can do is go online and you can create, there's a link I'll show you, where you can create your own FinCEN ID. And then all you need to do is provide that ID to whoever asked for it, because you're a beneficial owner. Okay. So I recommend doing that. I've done that because in my practice, I form LLCs, and I'm going to have to start providing that to all my clients who have to file those reports. For the legal entity, you have to provide the legal name, the trade names, the physical street address for its principal business, its jurisdiction of formation or registration, and its EIN or tax ID number. If it's a foreign company, then and there's no U.S. tax ID number, you're going to have to provide the tax ID number from the foreign jurisdiction and the name. The types of IDs that are accepted are non-expired driver's license, a non-expired ID. So like if you don't have a driver's license, but you have a state issued ID, that will work, or Indian tribe. A non-expired passport issued by a U.S. government, or a non-expired passport issued by a foreign government, only when the individual does not have one of the other three forms. So what are the reports due? If you formed an entity this year in 2024, so starting January 1, it's due 90 days from the date of formation. Now that's only for entities formed in 2024. If you form an entity starting January 1, 2025, that goes down from 90 days to 30 days. So they're offering a little bit of leeway because it's a brand new system and not everybody knows. So they want to give everybody a little bit of time to file that report. So if you formed an entity already, in January, you're coming up on your deadline. So you will need to start working on, filing your report. Okay. If this is an existing entity, in other words, an entity that was formed on or before December 31st, 2023, you have until January 1, 2025 to file your report. Okay. Now, once you've filed your report, that's it. You don't have to do this every year. You just do it once. Now, you are required to update your report or if anything changes. So if there's a new person who has substantial control, or there's an ownership transfer change where somebody else is now a 25% owner or acquires an additional 25%, you will need to go online and update your report, and you have 30 days from the date of the change. So you need to be, as a business owner, you need to be, or an entity owner, you need to be on top of who are your beneficial owners, because you have 30 days to file that change. If you become aware of incorrect information, let's say somebody provided you the wrong information and you find out, or they say, hey, I'm sorry, I sent you my old address, here's my new address, you have 30 days to file a correction, okay, to update that information, okay? Each subsidiary of a company has to report separately. There's no consolidated return for BOR reporting. So if you have a parent company and it owns 5 or 6 LLCs, you're going to be filing 6 or 7 BOR reports. Now, the nice thing is, if it's a parent company and you know what the ownership there is, well, then all the BORs are probably very similar for all those subsidiaries, right? So it does make it easier. And for subsidiaries, there's no way to provide the FinCEN ID of the parent company. You have to report it for each of those entities, okay? They have not created that there. The only exception for a subsidiary is if it falls within one of those, this is a subsidiary of an exempt entity, and it has to be, those exempt entities are prescribed in that list we talked about earlier. The last thing is only beneficial owners at the time of the filing of the initial report should be reported. So you don't have to go back and report all the beneficial owners that have ever existed. It's just as if you file your report today, February 10th, it's the beneficial owners as of that date. So there's an online website that you go to, and it's a really easy web form. You can go through, just fill all this out. It's really straightforward. There is an option on the website if you prefer to download a PDF form and fill it out that way. There's a way you can attach all of your ID information and all of that. I don't trust that PDF form won't break. It's probably better just to do the web form, but there is an option if you want to do an offline. To do a FinCEN ID, you go on the same website. There's an option there on the FinCEN BOI website for you to create a FinCEN ID. You'll need to create a login.gov ID, and then there's a website where you fill out all the information that you have to report as a beneficial owner or company applicant. And then you'll have to upload a scan of your ID, and it will provide you a number. You can print that out or save it, and then provide that anytime somebody asks for your beneficial ownership information. Penalties. Their penalties are pretty stiff. It's $500 for each day violation continues, and it could be criminal penalties, including imprisonment up for 2 years and a fine up to $10,000. If you provide false or fraudulent information, or if you willfully do not provide that information. And senior officers of the entity that fails to file the BOI report may be personally accountable. So if you are a senior officer of a company that needs to file a report, and that company does not file a report, you could be personally liable for penalties and criminal charges. If you are a beneficial owner and you provide incorrect information willfully, and that causes that company to go out of compliance, then you could be held accountable as well for civil or criminal penalties, right? Now, the Treasury has not talked about how they're going to enforce this, how the audit is going to work, but likely it's going to fall on IRS potentially. The FinCEN is also, the financial crimes is also responsible if you have foreign bank accounts for your FBAR filing. And FBAR filings are typically handled through IRS audit. So I guess that IRS audits will also include an audit of whether you file a beneficial owner report. And if they look at your beneficial owner report and they look at your tax return and it doesn't match, you may be subject to penalties. And lastly, this is the website for the FinCEN website where you can go online. There's frequently asked information, questions, and a compliance guide you can download to look through. And that's it. And if you have any other questions, feel free to reach out. We have about we have a little bit of time left for Q&A, and I'm happy to answer any questions.
Yeah, it looks like we have a few questions, Nima. The first question I think that you may have covered, but let's see, from Cheryl. From what we're being told in
Yes,
Texas and New York.
Absolutely correct. Yeah, what we're told in Texas and New York states is practice of law and CPA. Yes, so that's why I said CPAs will likely not be preparing this. In Texas even, all the CPAs that I work with as a tax attorney have called me and said, are you filing these or helping clients with these? And the answer is yes. So, the CPAs will not be doing this. It's practice of law. And I think there's another question from another person. If an entity's beneficial owners can't or don't want to complete the CTA report, how much might they expect to pay someone to do that? So there are companies out there that will file the beneficial ownership report for a company, but they will not help you figure out the information. They're going to say, provide us all the information and we'll file the report for you for a few $100s. But if you don't know who your beneficial owners are and you don't know if they're beneficial owners, then you're probably going to need to hire an attorney to help you with that. I know most of the registered agent companies will help you do that. My firm will do it, but we'll help you. We can help you do that. Most law firms, business law firms, will be working on this. So my suggestion is, if an entity is beneficial, so the entity is required to file the report, not the beneficial owners. So that's the other quirk. So the entity should check with its lawyer or general counsel on how on help with preparing that report. But the beneficial owners really, the question of whether somebody's a beneficial owner is not the beneficial owner's responsibility. It's the reporting company's responsibility to identify if they are. And so the reporting company will need to identify its beneficial owners and then go to those beneficial owners and say, hey, you are a beneficial owner. We need your name, date of birth, address, physical address, copy of your ID, all this other information, or your FinCEN ID number so that we can report that. So I would say a beneficial owner who may be asked for that information it may not be worth paying somebody to do that. I mean, it really is a web form online. If you've registered for a Yahoo or Gmail account, it's really straightforward. Just ask for your name, address, and if you have a driver's license, ask for your driver's license number. And you just upload a copy of your ID, and it's pretty easy to do.
Okay.
So I would say as a beneficial owner, it probably isn't worth it, but I know there's some companies out there will charge you a few $100s potentially to do it. Your attorney may do that to obtain the FinCEN ID for purposes of providing to companies of which you are a beneficial owner. But if you're the president of a reporting company and your company is required to file a report, that is something that you probably need to engage with an attorney to help you navigate on helping you identify who those beneficial owners are. And my law firm will file a report typically for a small fee, but if you want us to handle kind of helping you analyze that, that's typically at a per hour basis. That is the practice of law.
Okay. The next question.
That is a good question. It depends on when the LLC was formed. If it was formed before 2021, probably not. If it was formed before this year and dissolved, I would probably go ahead and file a report because again, it's for reports. You could take the position if it was ever in business in 2023, I would say it's better to report than not report, just because if there's any sort of audit of that year and the IRS looks to see if a BOR report was filed and it wasn't, then you may be subject to penalty. They haven't really provided a lot of guidance on that. So a lot of times, if it's not too difficult, I'd say file a report. You could also take the position potentially that's inactive if it really never did any business and it was formed prior to 2021. So, again, it depends on when it was formed and when it was dissolved and all of that. But, without knowing more details, I would say you should probably file a report to be safe. Somebody's asking for the website. It's fincen.gov. You go on that website, fincen.gov, and then those are the two specific links for the Entity Compliance Guide and BOI Facts.
Perfect. And this webinar was recorded, so if anyone wants to go ahead and revisit that, it will be on our website or our YouTube channel, Quest Trust Company YouTube channel. I put the link in the chat, and if you do a simple Google search, you'll be able to find this particular webinar. I don't think there were any questions, but really, Nima, thank you for this information.
Oh, there's one last question, which I think is really good. Sorry if you don't mind me asking it.
No worries.
So who has access to this info? Individuals do not. This is government only. It's subject to confidentiality. So if you hire somebody to prepare it, that person will have access to that information. I mean, they're just going to, because you're providing it all to somebody, a third party, to prepare it. So, do you want to trust CT with your information? That information, that's up to you. Your attorney is bound by attorney-client privilege. So if you use your attorney to file that report, your attorney will have to keep it confidential. Now, that doesn't mean somebody can't hack the system, their computer system, and steal that information. But as far as being able to subpoena that information from Treasury, that's not going to that shouldn't happen. And if it's an attorney, that's a privileged information for the attorney, and typically, most states that's privileged. But again, just like a tax return, is confidential. The IRS isn't going to provide a tax return to anybody unless they have specific authorization from the taxpayer to obtain it. They're not, the Treasury typically won't apply this or provide this information, but that doesn't mean it can't be subpoenaed in a proceeding or something like that. And then, at that point, if you use an attorney, it's subject to whatever, the attorney-client privilege is in that state, and whether that subpoena can trump it. So that's a really good question. I just wanted to highlight before.
Perfect. And they can reach you here, or is there any other?
Yes, you can go on to platterichmond.com. My information's there. My email is nfarzaneh@platterichmond.com. I'm on LinkedIn as well. Feel free to reach out to me there. My direct number is 469-707-2131. Feel free to give me a call. Email's better. It's just easier because I'm on the phone all the time as a lawyer. So shooting me an email or a LinkedIn message is the best way to get a hold of me.
You heard them, everybody. Really, thank you again to everyone for joining us today on this Saturday. Thank you again for the information, Nima. You guys give him a call. He knows what he's doing and looks to be of help to everyone for these types of filings and things concerning self-directed IRAs in this direction as well. So thank you for being here. And if nothing else, this will conclude our webinar for today.